Okay, welcome everyone, and thank you for joining us tonight. As we said, we have a special guest for you tonight who will be speaking to, in general, just real estate and passive investing, and of course the company that he works for. So our special guest tonight is Austin Rogers, and Austin is got a great presentation prepared, but I just wanted to make sure that I said hello first. Kemba and I are both on here. This is to help all our members and all of our guests tonight understand how real estate investing can be a very lucrative way to building a lifestyle today, a legacy for the future, and hopefully to helping many of us build our retirement assets and education plans and so on for our children. So please, if you are listening to this later, you can always, if you don't get to ask your questions tonight, you can always reach out to myself, Kemba, and or Austin to get answers to any questions that you might have. But if you're joining us tonight, you absolutely can ask your questions either by typing in the chat or raising your hand. We are looking forward to helping you understand more about how real estate, especially passive real estate investing, could be an excellent way for you to get into investing today. So, as I said, our special guest is Austin, and he is here from Equiton Capital, and he's going to speak to who he is and what he does and what he provides through his company, so that if you haven't heard of Equiton before, you'll have a really good understanding of what the company can do for you and anyone that you know that might be looking to invest passively or find other ways to earn income, especially, as I said, through real estate assets. And Emma, do you have anything that you want to say before we hand it over to Austin?
Welcome, Austin. We're glad to have you. Your presentations are always exciting and interesting, especially for those of us who are investing in real estate. So thanks for coming. I think everyone on the call would enjoy your presentations. And so we can get started.
Yes.
Amazing.
So, Austin, you have the floor now. I'll stop sharing. And then you can always
Perfect.
start.
Well, let me know when this pops up for you. Should be visible any second.
Yep.
Can you see that okay?
I can.
Amazing. Well, as you've noted, I'm really appreciative of you having me here again today to speak for the Keen Academy. I think what you are both doing is tremendously valuable in just providing really everyone with an opportunity to learn a little bit more in the real estate space, whether it's active investing, passive investing, whatever the case may be. It's great that we're able to get out and just provide some additional education so, people can really find out more, because there's always that saying of you don't know what you don't know. And it's events like this that really introduce you to new topics and help you learn about what else might be out there, especially from an investment perspective. So before I go too far into anything, I always think it's good to give a bit of an intro. My name is Austin Rogers, and I'm the Vice President for Equiton, specifically for the sales division or the private capital markets. And I think that it's important to just understand a little bit about my background so you know where I'm coming from in the investment space. I went through the normal courses of getting my bachelor through Ryerson University, now known as Toronto Metropolitan. And I used that business degree to go into what I thought was the best way of getting into investments. And that was really through one of the top 5 banks in Canada.
Okay, go back a little bit.
And so when you look at the top 5 banks in Canada, there's really an opportunity there to learn more about investing through some traditional routes like financial advising, for example. But after spending about 5 years in the bank, I really came to find that mutual funds was not the end all be all as it related to investing. And quite frankly, I wasn't really comfortable asking to take someone's entire portfolio and putting it into a mutual fund that, quite frankly, I didn't know what was going to happen with it. And so I started to look a little bit closer to what I was passionate about, and that was really looking at my family, because my mom was a real estate agent, my dad was a mortgage broker, and so by nature, I loved real estate, but I wanted to get involved from an investing standpoint. And it wasn't until about 5 years ago that I started doing the research and found out about a company like Equiton that allows individuals like myself and many others across Canada to invest into real estate without having to be a landlord and without having to deal with the headaches of owning a physical property. And so this introduced me to something that's called passive real estate investing. And over the last 5 years, I've been able to help almost 700 clients now get exposure to this new space. And it's something I'm quite passionate in talking about. So when you look at Equiton, I really just want you to think two things. One is trust, and the second thing is expert management who's managing the real estate assets. And as a firm, we really pride ourselves on being able to make real estate investing accessible to everybody across Canada by doing things like having a low minimum investment. Because the truth is, when you look at real estate in Canada right now, especially with the inflated prices, you could be looking at wanting to buy a rental property, and that can be a great idea. But just having the down payment alone can be a very tough task. You know, buying something in the GTA here, even if it's $800,000, you'd be looking at a minimum of a $160,000 down payment. But with something like Equiton, you can get started at as low as $10,000. And so this makes it a little bit more approachable for everybody to be able to get exposure to the real estate space, but be able to do it on your own terms. And it's nice to know that our management team has been the CEO of other development companies. You know, our CFO, Helen, she's been the manager at really big development firms in Canada. In fact, the #1 home builder. And so it's nice to know the people running Equiton are passionate about real estate. They didn't just have access to capital, they had a passion for real estate and wanted to be able to make that accessible to everybody in Canada. Just to put it in perspective, Equiton was a company that I joined back in 2019, but it was actually founded in 2015. But I wanted to show you just from the point of the company that I joined. And so when I had joined the company back in 2019, midway through 2019, the company had about $100 million of real estate that they managed. Fast forward 5 years, and where we're currently at right now is that we currently manage over $1 billion in real estate assets. And so the point to take away here is that we're not a startup.
Mm-hmm.
You're not investing in a company that is just getting going. You know, we're not learning things as we're, progressing along now. We have a very good track record of proven success, consistency in returns, and we now help over 13,000 investors across Canada get exposure to private real estate products. And so I just think it's nice to see the scope at which we've been able to grow, because that speaks to the trust that investors in Canada have given us over the last few years. So I want to make sure that we're all on the same page here when, looking at a presentation like this. I didn't want to focus it on Equiton solutions solely. I wanted to make sure that there's a little bit of value you could walk away from this presentation with that's just about real estate in general. And so one of the things I really want to focus on is why invest into multifamily in Canada. Now, multifamily is a funny word, and it depends what industry you're in, but really what we're talking about here is things like apartment buildings, rentals. However you want to consider it, it's just multiple units within a single dwelling that you can invest into. And I'm very passionate about this space because it's one of the things that Equiton focuses on is the rental market. So let's have a look at some of the stats then that I wanted to share with you, because some people might be thinking, what makes multifamily a good investment in Canada? And one of the funny things you'll come across is that when you look at the land that's available to us in Canada, you would think that there's just vast amounts of usable land that we couldn't possibly run out of. But the truth is, from a development standpoint, where you can actually build, we are running out of land. And a lot of that has to do with things like the Greenbelt, which is incredibly good from an environmental perspective, but it does limit the available room for you to be able to develop new properties. And so when you look at how many people are coming into Canada and how many people want to live here, it becomes very difficult to have enough new supply for everyone to be able to live comfortably and keep the prices at a reasonable level. And that's just not happening right now. So when you look at Canada's housing supply, one of the things I just wanted to note was that there's something called a G7. It looks at some of the top countries in the world from an economic standpoint. And one of the best things to see is that Canada is actually one of the strongest growing economies in the G7. However, we have the lowest housing growth, which is just such a bad balance to be finding when you're growing at such a rate, but you can't quite keep up from a housing development perspective. So let me show you just a little bit more detail on what I'm talking about there, because for us to get to a normalized rate where all the other countries are at, we would need to add today 1.8 million new homes just to get back to the average. But then we have a look back at the last 10 years and you say, well, how many homes are we building a year? And the shocking truth is we're only building about 200,000 homes a year, 188,000 that you can see. And sure, there's talks about wanting to improve the development and build more homes. But with the way interest rates have been going, there's a ton of developers actually pulling out of new development projects. And that means that there's actually a forecast that that number could potentially drop this year and potentially even next year. So it's a very scary situation when you look at the inflation crisis and all the prices going up, especially for rent, because a lot of it has to do with the undersupply of housing. And really, based on what the numbers are that we're looking at right now, there's just no way we're going to be able to catch up. So how bad is this problem going to get? So if you were to look all the way out until 2030, it's projected that we're going to build about 2.3 million new housing units, which is an improvement. It means we should see growth in the number of new homes brought online. But with the way things are going from a growth perspective, especially with things like immigration, in reality, by the time we get to 2030, on top of that 2.3 million that we're planning to build, we would need an additional 3.5 million more homes to restore affordability. And so when you think about an investment category that can be really beneficial to be a part of over the next few years, I really think multifamily is a great one to consider, because you just look at the fact that the supply-demand imbalance is going to be so dramatic over the next few years. And then when you look at some external factors, because yes, we have some housing supply issues here, but a lot of that is going to be exacerbated by the fact that we bring in a lot of people to the country every year. And that's part of the reason we have some of the best economic growth. We need immigration in a country like Canada in order to sustain good growth rates. But if you look at how many people we're planning on bringing in, it's about 500,000 people a year. But the true reality is, if you look at the data over the last few years, we were supposed to bring in 500,000, but we're much closer to 1 million people over the last few years. So we're going way above the targeted projection. So think about that in relation to the supply numbers I just showed you. We're really only building about 200,000 homes a year. There's a plan to try and increase that number, but until you see it, it's not true. And we're bringing in 500,000 people. So it's just like, doesn't take a mathematician to really look at this equation and say, like, if we're bringing in 500,000 people and only building 200,000 homes, we're almost guaranteeing that we're going to continue to make the rental problem even worse over the next few years. And that's where you can really look at the fact that I think that this is kind of pointing to the rise of the Canadian rental market. And I wouldn't even say rise, because I think that's understating the problem, where if you look at the pace at which rentals have been growing over the last 2 years, 3 years, 5 years, it's just dramatic. Like, you take a look at realtor.ca and put on the rentals and have a look at the prices in your own community, you'll see it. It's incredibly high right now. And that's part of the conversation that goes into inflation. All prices have really been going up, but rents have been dramatically going up. So when you look at real estate, you've really got two options. You can either go the active route, which would be buying a physical property and managing it for yourself, or going passively, which is where you would look at investing into a company like Equiton, which is going to manage the real estate and drive the returns while using investor capital to be able to do so. So it's a lot more hands-off. But I will never sugarcoat the fact that if you're someone who has the cash to put down on a rental property, and you have the bank financing in order to be able to go and buy that rental property, and you have the time to be able to manage that asset and work with the tenants, active real estate is one of the best ways to invest in Canada. So I will never negate that point. But I think the point of listening to me today and kind of hearing about Equiton is just knowing which part of your portfolio are you using and are you getting the most value out of it? Because what a lot of people don't know is that if you have an RSP, or if you have a TFSA, or you have a locked-in retirement account from an old pension, you can use all of those registered vehicles to get access to a passive real estate investment. So regardless of the fact of if you're someone who loves active investing and you have the cash and you're able to buy your own rental properties and manage it yourself, you could actually find that you have a gap in your portfolio where your RSP could be entirely mutual funds at a bank branch. And really, are you getting the best return or the most consistent return possible? Maybe, maybe not. But this is just to add some food for thought and consider if private real estate investing is something that you take a keen interest to. And the one thing I want to show is that there is two different ways of investing passively into real estate. You can invest into real estate passively on the public stock market, or you can invest privately. And I just wanted to illustrate some of the differences you'll find. Because when you look at a public real estate investment, I want you to know that the value of a public investment is driven by market forces. And what I mean by that is, if we all think that a certain real estate company is good and we buy into that investment, it will drive the price up. If we all decide that we don't like the real estate investment and sell it, we will drive the price down. But the reality is it's all just how we perceive that real estate to be performing. When you look at a private real estate investment, the only time that you will really see a positive or a negative return is when the valuation of that real estate is higher or lower. And so the private investment market gives you just a little bit more of a true valuation of what the real estate is worth at any given point in time. And so an example I want to give is that in 2022, the public stock market had one of the biggest crashes that we've seen in pretty much the last 15 years. And for example, the public real estate index was down about 17% in 2022. But if you were to look at the private investment space, and this is not Equiton, this is just private Canadian apartments in general, that index was up about 5% in 2022. And you'd probably ask yourself why. And it's because on the public side, the sentiment was bad. And so people were selling, but that didn't necessarily mean that the real estate wasn't still collecting rent from tenants, that the value of the bricks and mortar that went into it was worth the same, and the land at which it sit on was still valued relatively normally. And that's what you got with the private market, was a much more true reflection of the fact that real estate was still a good market to be invested in during 2022. And in fact, you just got to avoid all of the volatility that came along with the noise of the stock market. And I don't want you to take my word for it. I actually wanted to show you some historical proof of what that looks like. So again, this is not Equiton. What you are looking at is the performance of just private investments into Canadian apartments over the last 39 years. And what I want you to see is the level of volatility, or should I say the lack of volatility. Because the truth is, over 39 years, this index for private Canadian apartments has never had a negative year of performance. And I would argue anybody to try and find me any other index in Canada or the US that has never had a negative year of performance in 39 years. I would argue that that's one of the most astounding figures when you're looking at investment vehicles for consistency. And this is part of the reason why I'm so passionate about specifically the multifamily space, but just real estate in general in Canada, is that we just have such a lack of supply and such a huge amount of demand. And that's part of the reason why you see that this chart is so consistent over nearly 40 years and pretty much highlighted all of the major financial events over that time frame too. It was positive during COVID. It was positive during the inflation crisis recently, and all the way back to the global financial crisis in 2008. This is just a perfect illustration of looking at the benefits of being privately invested into real estate. And I think a really important point to understand is that prior to 2016 in Canada, private investments were not available to everybody. In fact, unless you were an accredited investor, which is what you'll see on the left side there, you could not invest into private products. And I'll give you an example. For you to be an accredited investor, the thresholds are very high. Now, I think we all want to get into the accredited category, but just for example's sake, you have to hit one of these 4 criteria. You don't need to hit all of them. You can just hit one. But even still, you have to have a personal income that exceeds $200,000 a year, or a household income that exceeds $300,000 a year, liquid assets that are greater than $1 million, or having a net worth greater than 5 million. That's not easily obtainable, and that makes private investments incredibly difficult to get access to. But then a few years ago, the rules were changed and it opened up what was called an eligible investor category, which means that if you have an income that exceeds 75,000, or you have a household income that exceeds 125,000, or if you have a net worth that exceeds 400,000, you can now invest into private products. And this will vary a little bit province to province, but generally speaking, that's pretty much the way it works. And that means you can invest up to a maximum of 100,000, which is a very generous limit. It's very high. And that's the maximum. That's not the amount you have to invest. It's just the peak of what you could do. And you might be sitting there saying, okay, well, I don't have an income of 75,000 or a net worth of 400,000, and that's okay, because they have what's called a non-eligible investor. And I got to tell you, it's the worst name for a qualification, because you can still invest. You are technically not non-eligible. It just means that you're limited to a maximum investment of $10,000. Now, at the beginning of this presentation, I said, we want to make investments accessible to everybody. Well, the only way to do that was by ensuring that our product, one of them called the Income and Development Fund, had a minimum of $10,000. This way, even if you are a non-eligible investor, you can still participate in something like the Income and Development Fund through Equiton. But I think this is a great slide just for understanding what makes you qualified to invest in Canada and what the certain limitations might look like. And it's just useful information to understand a little bit more about this space. So I've already gone on for about 25 minutes here just about the real estate market in general in Canada. So why don't I just give you a snapshot of what we do here at Equiton? And then I'll tell you just a little piece about each one of these different investment solutions. Because here's the thing, when you look at Equiton, I don't like to overcomplicate things. We only have 3 different investment solutions. And very quickly, when you look at this slide, what you're looking at is the range of products that we have. And I want you to consider something. When you look at the left side of the screen and you see 8 to 12% for something like the apartment fund, I want you to know that the returns that you see on the left side for 8 to 12% is because that is our most conservative investment that has consistent returns every single year. And it's the lowest in terms of the risk profile. And if you were to jump all the way to the right side, where you see Equiton Development Investments, those are going to be higher risk investments with the potential for much higher rates of return. And so the idea here is don't get caught up in the words on the screen and everything that you're seeing here. Understand that anytime you move higher on the return scale, you're always moving higher on the risk scale. And so at Equiton, we have various solutions so that regardless of what your investment objective is, your time frame, or what you're looking to get out of investment, we likely have a solution that might make sense for you. And that's one of the key components of what we do, is making sure that we can offer a diversified range of investments that are in and of themselves a diversified real estate investment product. And so what I'll do is I'll spend the last 5 minutes here just giving you a very quick snapshot of what each one of these investments does. So if we start with the first option, it's the one that targets 8 to 12%. We call this the Equiton Apartment Fund. And the idea here is pretty simple. Think about it as if you went out and bought a rental property today. If you went out and bought a rental property right now, you would get 3 things from owning that rental property. The first thing you would get is monthly cash flow being paid to you by your tenant. The second thing is you would use that monthly cash from the tenant to pay down the mortgage on the property, which frees up a little bit of equity. And the third thing is you would hope that the value of your property will appreciate over time. Well, really, that just works out to 2 different profit centers. One's monthly cash flow and one's capital appreciation. Capital appreciation is that idea of buying a property for $1 million and it turns into a $1.1 million property. Well, you would make 10% in that case. So our fund emulates the strategy. Just instead of you having to go out and buy your own apartment building, or manage a rental property or a rental condo, you can simply buy the Equiton apartment fund, which, by the way, has 34 properties worth about $1 billion just in that portfolio. And you become a part owner of that entire.
Enjoying our podcast? Stay connected beyond the episodes by following us on our other social media channels for exclusive content and updates. Don't forget to hit the subscribe, like, and share to help us grow and reach even more listeners. Your support means the world to us. Let's keep the conversation going.